Welcome back to Asia First. Let's get you that check on the Greater China market open. As promised, the first one for 2023, some weakness on the mainland. We already got data over the weekend that showed the economic activity in China slowing significantly in the month of December. And this morning, a private survey of manufacturing confirms that we're seeing the PMI for Caixin manufacturing coming in at 49. That is contraction territory and more or less in line with expectations. Hong Kong's Hang Seng seeing much steeper losses in line with the 1+% declines in the Australian and the South Korean gauges. Let's bring in Olivier Dacier. He is head of applied research for APAC at Contigo. So Olivier, the concern now seems to have been shifted to China versus what was the main concern last year, monetary tightening, potential recession for the US and EU. But talk to us about what exactly the risk from the Asian giant entails. Is it going to be that shoppers in the near term are just not coming out because of their fears of the virus, or that when they do come out, they're going to cause inflation globally?
I think that the concerns on China are multiple, right? There is a lack of transparency for now for investors to be able to predict what will happen. The realized data that we get from the economy is much lower than the predicted data from official sources, even probably for next year. So for now, it's too hard for them to make a prediction. And the other, you got to put this in the context of the global economy. You have the US and Europe slowing down as well. So if China is also slowing down, which it is, where is the engine of growth for global economy? And that's one of the issues right now. China was always uncorrelated with the rest of the world. It was growing when the rest of the world was slowing down and providing some relief. But today it is slowing, and the predictions are for the other two major economic blocs, the US and Europe, to also slow. So that is raising concerns for investors.
But the slowdown in the US and the EU in some way has been quite well telegraphed for the second half of last year. That seemed to be all that we were talking about. So does this give us, more hope that when we do get a tailwind from China, the focus then shifts more towards what comes out of the mainland?
Well, we hope so, but it's very hard to say, right? So investors got it all wrong in 2022, right? They got it wrong about Russia not invading Ukraine. They got it wrong about, the pandemic being over. We're still seeing a lot of restrictions from that, and a renewed wave in China and other parts of the world is causing more reactions to the pandemic. So it is not over. We also got it wrong in terms of inflation having peaked in 2021. It's still growing. We got it wrong with cryptocurrencies being safe or uncorrelated with markets, with equity markets. We got it wrong with central banks always stepping in to rescue investors when things got tough. So I think for investors right now, the climate is very uncertain, and investing is forecasting. And if you can't make a forecast, and at the same time, volatility in the markets is still elevated, it's still about twice as high as it was back before the pandemic, and it's still, lower than it was at the peak of the worries this year in the summer, but it's still very high, which means 2022 has been the biggest loss for investors since 2008 in terms of equity. Getting it wrong was punished the most it has since 2008. So for that reason alone, investors are quite risk averse when it comes to making a forecast for at least the first half of 2023. And if China is still slowing down, we're not seeing signs of a bottom. We're seeing signs that Europe is slowing down fast. The US is slowing down a little bit slower. But where is this bottom? And is it a V-shaped bottom or a U-shaped bottom? The investors cannot predict this right now, and therefore they remain very, very risk averse, and they remain, uncommitting to big risk tolerant types of strategies. They're still implementing risk averse strategies right now.
What does this mean for the kind of defensive sectors that we might see become more popular this year?
That's right. So risk-averse strategies have outperformed for 2 years in a row now, which means that some of these, defensive sectors or defensive styles are getting quite pricey from a valuation point of view, right? Value has outperformed growth for now 2 years in a row. People are chasing profitable stocks that pay dividend yields. These things have been chased for quite some time now, and they're getting expensive. And we see the reflection of that in market volumes, which are still much lower than they were in the first half of 2022. So as investors have positioned themselves for the uncertainty and the volatility in the markets, and then they stopped. They just said, you know what, there is interest now. You're getting paid for sitting on the sideline. If you don't know, if you can't make a forecast and you're uncertain, the sideline will pay you 3.5%, 4+% in fixed deposits. So there's no longer this fear of missing out that drives people back into the market every time there's a small dip, because you're getting paid for just staying put for now.
And that might, cap the kind of downside that we see, or maybe increase the volatility. Olivier, thanks very much for sharing your analysis with us. Much appreciated. Olivier Dacier is Head of Applied Research for APAC at Contigo.